Yesterday, we talked all about how layoffs are starting to pile up in the job market, how people are starting to Google the word layoff. There was a lot of stories about companies laying off hundreds of employees and when we can expect to start seeing that in the data. Now, historically, big surges in unemployment and layoffs typically leads to problems in the housing market. So we wanted to look at the data this time to see when can we expect these problems in the housing market to start showing up in the data points. And with that, we got to shrink my big melon of a head, and I need
Hey.
my man, Mr. Mod, because we're going to dig into some numbers again.
Yeah,
How we
good
doing today,
morning,
Mitch?
everybody. It's a great day. We're going to be doing a lot of number work today in charts, and I just want everybody to know that we are using median numbers where possible, and we're getting them all from the Fed where possible.
Yep. Median numbers, again, that's not the average. That is where the majority of the population lies because averages can be skewed by the multi-million dollar
Mhm.
McMansions, right? So we're going to median where most people lie.
On the bell curve, we're kind of taking that chunk in the bell curve.
So real quick, yesterday when we did the look at unemployment and layoffs, we checked out Google Trends
Hmm.
as an indicator of is the problem in the labor market starting, and we saw a pretty substantial increase over time over the last couple of months in people googling the word layoff. So I wanted to look at the same comparison for foreclosures right now because ultimately I think layoffs lead to foreclosures. And looking at Google Trends over the last year, flatline right now. Nobody's
Yeah.
looking at foreclosures.
There's little upticks here and there, but for the most part, no.
Yeah.
No one cares right now.
So this tells me people aren't worried about losing their house, even though jobs are starting to disappear. People are starting to lose their jobs. We saw that yesterday, but they're not worried about their house. And why is that? It comes down to the word equity. People have equity. And here we go. The median sale price of homes sold in the United States going back to about 2015. And this is what the median sale price has done. And look at how these home values have just exploded, especially since the pandemic.
Yeah, it's just gone straight up, and it is ridiculous because a median income in 2015, or median house price in 2015 was 212,000, and today it's 426,000. So in 7 years, it's gone up $185,000.
So what does that mean? Let's say you're one of those people, one of those 1,100 Coinbase employees we talked about yesterday, one of those 300 Netflix employees, or one of those aluminum smelters that just got laid off. That means you're sitting on an asset that is worth a whole heck of a lot more than you paid for it. You've got equity. How much equity do you have? Well, we went looking, and this is on Investopedia here. The average mortgage holder now has $185,000 in home equity. That is a significant amount of change.
That's triple the average income for a person in any
Yeah.
year.
So we wanted to look at okay, if are people using this equity? Say people start losing their jobs. How long can they hold on to their house to avoid foreclosure? What can they do other than putting their house up for sale? So I went looking to see what are people doing with their equity, and I found this article in Fox Business from May 20th. HELOC loans surged at the end of 2021 amid rising mortgage rates, according to TransUnion. Now we got to talk about HELOC and
Yep.
what that is. HELOC stands for Home Equity Line of Credit, basically a way for you to borrow that value of your home.
Your parents called it a second mortgage.
If you hear second mortgage, HELOC may be one of the things that they've taken out on that. Now, before the end of 2021, what most people were doing to tap the equity in their home was they were doing a cash out refi, where they would refinance their existing mortgage under a lower interest rate, and they would also borrow against the increase in the value of their house,
Mhm.
and they'd take the difference in cash. Right? That's a cash out refi. The problem is, since the end of 2021, mortgage rates have gone a lot higher. So it doesn't make sense to do a cash out refi now because you'd be taking your existing debt and rolling it into a higher interest rate. Your payments would be going up.
Right, which
So, yeah, now that cash out refis are off the table, people are looking at these HELOC loans as an alternate way to get to their equity. So we want to look at what does it look like if you're that Netflix employee and
mhm.
you live in the median house and you've got the median $185,000 of equity in that house. How long can you make it on that payment? Now we talked a couple of months ago that the average homeowner has about a $3,000 payment right
Yep.
now, right? And using typical calculations, you're supposed to spend about a third of your income on lodging. So that means the average person probably has about $9,000 a month in household expenses. That's the average household.
Hmm. Remember, when we're talking about this 3,000 payment, that's everything. That's the principal, the interest, the insurance, and the taxes all together. So there's about $3,000 all told.
All right, so if this guy he just lost his job and he needs $9,000 a month to stay solvent right now, and if he's got 185,000, which is the median equity that homeowners have now, I mean he can usually borrow about 80% of that equity is what the bank will let you tap into. So you've got about
Hmm.
$148,000 available to you in your home equity line of credit, which means at your $9,000 a month living expenses, you can make it as much as 16 months
Yep.
before you're out of money,
But
right?
you're
And
out.
that's living off of your equity, right? 16 months, best case scenario. All right. Now here's the thing: if you lose your job, and as people lose their jobs, the housing market is going to start to decline. Home
Right.
values are going to start to drop. So you're never going to get to borrow this full 148,000 because 6 months from now, 8 months from now, the bank is going to call you up and they're going to say, "We've reassessed your situation. Your home is now underwater. We're cutting off your home
Yeah.
equity line of credit." And
Assuming your HELOC gets a margin call on it.
it's basically, yeah.
Yeah, you're done. This is it. This is all you're getting.
So now you've got the problem. You have no income. Your house is underwater. You've got your existing mortgage payment. And now, depending on how much you borrowed, you've got something like your draw period payment of about $900 a month
Yeah.
on top of that. So, what does a homeowner do in this situation? Probably just walks away from the house,
You,
files for bankruptcy, right?
I think so. I think we learned that in 2007 and 8 that process was so lengthy and so painful that a lot of people just got up and walked away. And I think we're really going to see that because a lot of homeowners today saw their parents going through it 10, 15 years ago. And it's about 15 years ago. So either one, the person's already been through it and they're not going to go through it again, or two, these kids watched their parents go through it and they're not going to go through it again. So I think this one's going to be a little bit different on that.
So, going back to this chart, the median sale price of homes sold in the United States, this chart is still rising right now. All right. Median prices are still going up. So, as long as median sale price is still going up, people can continue to tap into that
Mm-hmm.
equity. Now their payments, their monthly payments are going up, but they can use that as a bridge until they find work, assuming they're able to find work. Personally, I think we're looking at a lot of layoffs. We talked about that yesterday in the horizon. So I don't think a lot of these people are going to be able to find work. If they do, it's not going to be as good as what they had. So really what we have right now with the layoffs are starting and people tapping into their equity to make ends meet, we're looking at a clock is starting. All right. And as that clock starts, really that clock starts when this chart levels off here. When the median sale price starts to decline, that means people's HELOCs are going to start getting cut off. They're
Now
going
we're
to lose their
close to
ability.
hitting rollover right now.
Absolutely. I mean, we're clearly in the process of topping, but we haven't started coming down yet. Now, when we start coming down, that's when that clock starts to
Okay.
speed up because now people are losing their home equity lines of credit.
Now they've been doing this now since December of last year. So the craze, if you will, already started. But that doesn't change the end date because the prices haven't gone down yet.
So, in a nutshell, if you had to ask me, I'd say we are somewhere from 6 months to a year away from a wave of foreclosures being caused by the spike in layoffs that we're starting to see right now, being caused by people drawing down their credit, and by banks in this higher rate environment and getting more risk averse, banks starting to cut off those home equity lines of credit. I think we are 6 months to a year away from a spike in foreclosures in the real estate market.
Yeah, I agree. We're about a year out.
And also keep in mind, as people lose their jobs, you have more home inventory hits the market. That tends to suppress prices as well, and that could accelerate the bank's timeline of cutting off those HELOCs. So let us know, guys. What are you seeing in your local? Are you seeing a spike in foreclosures in your area yet? Let us know down in the comments what you guys are seeing. Have home prices in your area topped? And until next time, Mish,
Spay and neuter your pets.
and live small and dream big.